Well, hi everyone, Shaun Humphries here with Assante Capital Management and the Humphries Wealth Group. Again, welcome to this installment of the video series and course that we put together around successful investing. So we've talked about the importance of understanding those issues that get in the way of successful investing. A lot of it's between our ears, our headspace, the psychology and emotion around investing. We talked about how critically important it is to have clear goals before you develop a portfolio, because your goals will really define for you the investment strategy that you need to be taking a look at. The next piece is, what is your appetite for risk? So we don't want to construct portfolios in a vacuum. Portfolios do need to take into account your own personal risk appetite, how much risk you can tolerate. And we go back to the very first presentation video we put together in this series. We talked about family of origin and our backgrounds. And so there's a lot of things that influence us as we take a look at portfolios and as we digest risk around those portfolios. So we're going to unpack this in a little bit of detail and talk about a particular diagnostic tool that we use to help clients get clarity in this area. I think this is a great schematic. It really is this balancing act between the amount of financial risk we take on and, of course, the amount of money or capital we can potentially make. Now, in the work that we do, most of our clients view their portfolios with us as a very foundational piece of their income security planning. And as a consequence, we really approach portfolios almost like pension plans, where consistency of return, reducing risk, try to have as much predictability as possible in portfolios is a really important priority. But even in that context, there's a whole range of investment portfolios we could design for a client, and each of those portfolios will have a different profile in terms of return and the amount of risk that a client takes on. So when you take a look at this continuum between risk and return, what needs to happen is a bit of an iterative process. In other words, we sit down with a client, or you look at your own planning, you get very clear on your goals, and then you do some modeling or forecasting, and we've talked about the importance of financial modeling in past videos. The financial modeling based on certain assumptions, and one of the assumptions will be return assumptions on the portfolio, will give you an idea as to whether you're tracking in the right direction to reach your goals. So a good example is I could say to a client, you need to get a 5.25% return after investment management fees to reach your financial goals and objectives. And when you put a portfolio in place, it gives you the probability of getting that kind of return. Here's the level of risk that's going to expose you to, and when you build that portfolio. Now, for some clients, they'd look at that and go, that's an acceptable range of risk, and I'm fine with that. And other clients will look at that and go, you know, Shaun, I'm not sure that I could really stomach that level of fluctuation in my account. I want to be more conservative. So what we do then is we go back to the portfolio forecasting, the financial forecasting, and we use a more conservative portfolio to model that forecast. And let's say if we reduce the return from 5.25% to 4% to reflect a more conservative portfolio, or let's say 3.75%, whatever the number is, then the client can see the impact of that decision. And it might mean less lifestyle in terms of the retirement years because the portfolio is getting less return. It may mean that if they take the same level of capital, they're running out of money faster than they thought, they're killing the goose that lays the golden egg more quickly. They might have to go into home equity, cottage property, recreational property to create additional income sources later on in the retirement. But at least they can see the trade-offs. And what I see with many clients is once we do the analysis, many times people will go, listen, I'm not sure that I want to build a portfolio strictly on a more conservative strategy because I can see, given current interest rates and being more conservative, that's going to put a lot of pressure on my portfolio. I wouldn't mind adding a little bit of risk to my account to try to drive potential returns. And that's the way the discussion should really start. And then there's an educational process around the trade-offs between the amount of risk we take on and the potential return. So we use a risk profile questionnaire to try to get a handle on the client's appetite for financial risk. Now, the challenge for these, when it comes to these questionnaires, is the fact that it's often done in isolation. It's kind of done in a vacuum. We never completely understand how we're going to react to volatile capital markets until we're right in the midst of them. But at least it's an assessment tool that the client can look at and kind of confirm, yeah, that fairly represents my appetite for risk and variability of return on the portfolio. So what I've done is I've put together a couple of slides to give you an idea of the kind of questions that get asked in these forms, and I'll actually show you the form itself in this video. So here's a sample question. And so again, these questions get asked a little bit in a vacuum, but at least it gets a conversation going around risk and return and volatility. So this question says, the chart below shows a relationship between a portfolio's average return and the minimum loss that could be expected once in every 6 years. As the chart shows, the higher the average annual rate of return, the greater the probable loss in a down market. Which portfolio most closely reflects your willingness to accept greater risk to achieve greater potential returns? So you've got this range of returns here. You can see the portfolio with the least amount of downside risk, and this would be the minimum downside every 6 years. Could be greater than this, but it's got a downside here of basically, it looks minus 3% in 1 year, with an average expected return of just over 5% on the portfolio. If I go to this middle of the road portfolio here, you can see the returns have gone from just over 5% to the range of, let's say, 6.5% to 7%, but you can have a downside of minus 5% at some point in the next 6 years on an annualized basis, let's say. Could be higher, but that's the minimum that you could potentially expect. And then the return with the greatest performance, it's between 9 and 10% per year, and could have minus 10% 1 year in terms of performance. And so as best we can, we need to look at those numbers and say, well, what could I live with? If I was actually down 10%, sure, I'd like to get close to 10% returns, but if the cost was a 10% decline at one point in the next 6 years, could I live with that? Would I be able to be disciplined in my approach to the portfolio? So again, it's one of several questions we ask, but it gives people understanding of the connection between return and risk. Here's another question. Which of the following statements best describes your willingness to tolerate decreases in the value of your portfolio from one quarter to the next? Now, this is a really important question because a quarter is a very, very short period of time in terms of investment strategy. And yet, if I'm talking to a client who would become really unnerved with short-term volatility over a 3-month period, then obviously we need to take that into account when we design the portfolio. So you can see this first question is not at all. I'm not going to be concerned about a quarterly decline. I can tolerate small decreases, anywhere from 0 to minus 5% in a quarter. I can tolerate medium size, minus 6 to minus 12. I'm not worried about the size of any quarterly loss. Okay. It's really interesting. In a future video, we'll talk about ranges of return on portfolios, and over the last 20 years, it's amazing, 30 years, it's amazing how many years where within the year the returns have been very poor, but by the time you hit the end of the calendar year, investment markets are in positive territory. So you can see a fair amount of fluctuation year by year within the year and still end up in good positive return range for a portfolio. But this is a really important question because if a client can't stomach any quarterly losses, has a very low appetite for risk over that short time period, that obviously going to influence the portfolio strategy. For those clients that aren't too concerned about quarterly losses, maybe the third question here, minus 6 to minus 12, or not concerned about quarterly losses at all, it gives a lot more flexibility to the designer of the portfolio in terms of the strategy that gets used. Now let's just take a look at the sample form that we use for this particular exercise. So this particular form you see in front of you is really comprised of a series of questions, and all the questions are sort of framed in different categories. There could be questions around age. There could be questions around portfolio objectives, need for liquidity. And all of these, and of course questions around your response to market volatility. And all these questions sort of filter into a recommendation on the kind of investment mix that would be most appropriate for you. So you can see here there's a section on your investment personality. So what is your age? How long are you planning to let the majority of your savings grow? That has an impact. How would you describe your investment knowledge? Is it novice, fair, good, sophisticated? And that's an important question because the less sophisticated you are, the more you'll be at the mercy of knee-jerk reactions when there's surprises in capital markets. We're a real big believer in financial education, financial literacy, particularly when it comes to investing, because better educated clients who understand the basics, they don't have to become experts, but understand the basics around this category and this topic, behave with more discipline, and there's a higher probability that they'll be successful. How long will you be using the majority of this portfolio, or how will you be using it? So to fund current lifestyle, it could be future retirement, it might be charitable giving, estates, value for the next generation. All those things have an impact on portfolio design. So there's a number of different questions, and those questions filter into a final diagnostic on, we also have investment preferences, and then you end up totaling all the different categories, and it begins to start the discussion around the right mix for a client. So you can see here, depending on the scoring of this particular worksheet, a client might come out at 80-20, meaning 20% income investments or capital preservation, 80% growth investments. So it might be a portfolio that matches up with their risk temperament. Another client might come out 70-30, 70% capital preservation, 30% growth. Now this is important because when we go back to the financial plan might have assumed that we have to get a return that's more synonymous with a portfolio that's 30% capital preservation, 70% growth, not the other way around. So now that's a magic moment discussion for us. Do we have to go through an educational process? Do we use more conservative assumptions, meaning we have to redo the financial forecast? It's this back and forth discussion, and it's really to inform the client what the trade-off decisions are, or what the trade-off implications are of the decisions that they're making on their portfolio. This is not a right or wrong exercise. I don't come to the table when I work with my own clients having a bias towards this is how you should invest in terms of mix and volatility. It has to be crafted and customized to the client's situation. That's absolutely critical. But the client and you need to understand the implications of these decisions. In other words, you can't make a decision today about risk appetite and then in the middle of a market fluctuations having a knee-jerk reaction to that. We need to have a very frank discussion at the front end before we invest money, and we need to understand what the implications of those decisions are. Well, it's my hope that you found this discussion, this video on risk, helpful. So again, we start with the goals that you have for whatever your objectives are. We take a look at assumptions, and return is one of those assumptions. Every client needs to understand the implications of returns. So obviously the higher the return, the greater the risk or fluctuation. And then there's this iterative process where you take a look at the trade-offs between your financial forecasting and your portfolio and try to gradually come to a consensus opinion around how much risk do I want to take on, do I understand the implications of that, and then going forward you can begin building a portfolio that's responsive to that. Well, you may know family, friends, co-workers that could benefit from this kind of discussion, so don't hesitate to forward this video on to them for the review. We also have our contact information, and really the question is, have you ever considered working with a retirement coach, a financial coach on these issues? If you're intrigued by the idea, then don't hesitate to reach out to us. Here's the email information, humphries@assante.com, contact information 204-977-8049, of course, our website, shaunhumphries.com. You take care, and I wish you all the best with your investment planning, your overall wealth planning.